My name is Al Salus. I'll be walking you through this webinar today. Everybody gets cap rate wrong. It's a little bit of hyperbole, but I came across a couple of conversations with a little newer people in the industry and some savvy people, and I felt like, this cap rate sounds so simple, but it's also needs some demystification to clarify the concept. So what I'll go through today, I'll go through the outline in a bit. Basically, this is an educational purpose webinar. Don't take any legal or financial advice from us. You can seek your legal financial advisors before you make any financial decisions going forward. Just want to get that out of the way. For today's webinar, we're going to be talking about what is cap rate, why does it matter, what factors impact the cap rate value, and we'll go through some real world examples. I was blessed to see a lot of reports that came out actually this morning. So we have some fresh data covering some Q4 data as well. What are the common misconceptions about the cap rate, and why are they sometimes perceived wrongly? I'm going to briefly touch on a 2024 outlook based on our vantage point for the market and its impact on cap rate as well. And then briefly talk about our approach when it comes to the investment. My aim is to try to finish all that in 30 minutes and leave 15 minutes for Q&A at the end. Like Sammy mentioned, if you have any questions, please type it in the chat, and then we'll go through a live Q&A at the end. So just from a basic definition on the cap rate, it's basically the return on a property. It's a very simple formula that calculates the net operating income, after we pay the property insurance, taxes, maintenance, labor, and management fees, and divide that by the purchase price. So it's basically the profitability of that investment. So this is an example here, a simple example of a $5 million property that generates about $400,000. That would give us 8% cap. For the M&A folks and the non-real estate conversations, it's basically EBITDA multiples and the inverse of that. So instead of talking multiples when we evaluate a business for purchase or exit, it's the inverse of that, and that's what's common in the commercial real estate space. So why does it matter? We use it as a main decision-making metric. Commercial real estate properties typically are valued based on the income. It's directly proportional to the income, as you saw from the equation, unlike the residential properties, which are more dictated by the comps and the recent sales. It is important to use a market-driven parameter so we can compare apples to apples, because you can have two identical properties in the same zip code and two different income position that will drive two different values. So using a normalized metric like the cap rate helps investors look at things from apples to apples point of view. It's not just a calculation, it's not just a profitability percentage, as simple as it is, but it's also it gives a lot more insight onto the quality and the quantity of that income and that profit for the investment. Whether it's a stable income, a predictable income, or is it going to be a higher percentage, but maybe not as stable and predictable. So you'll see that in why it might be a reverse logic sometimes when you look at cap rate when it comes to nicer, more stable properties. The same thing, it does tie in the overall investor's appetite and the availability of capital to invest into an asset class. So you might find that cap rate has a strong correlation with interest rate, and we'll talk about that in more detail. But also how many available investments are in such a market? Are everybody buying multifamily? Is everybody moving to industrial? And that will impact, from a supply and demand of the investment, it will impact the cap rate. So it's a combination of straightforward profitability, but it touches all of these, and we'll talk about them one by one. So we'll start with location. One of the major factors that impacts cap rate is location. What market is it in? What submarket is it in? Real estate is very local. So when you look at high demand areas, typically it's lower cap rates. And the reason is investors are willing to pay premium in more growth markets because of the quality of that income. So it will be a lower cash flow for their investment, but they're confident they're going to have a stable and they're going to be confident about that stream of income. And so just like the location, the same logic applies on the property type. If it's a multifamily, industrial, retail, the more consistent and stable that stream of income, the lower the cap rate. In general, there's always an exception to a lot of these, and that's why you can see the interrelationship between them. But as long as the income is stable and consistent, investors are willing to pay more premium for these properties, and hence the lower cap rate. Things like, when it comes to retail and industrial, if it has a longer lease term, stronger tenant credit, stronger tenant demand, low vacancy, those are all great things that tend to drive cap rate down. Similarly, in multifamily, the higher the number of units, the lower the vacancy drives similar results, which is a lower cap rate. On the top right side, when we talk about the property condition, this is a function of how much renovation and improvement the property needs. So properties that needs heavy capex and a major operational overhaul would definitely be riskier. And although they might yield, and normally they would, if managed properly, higher returns and cash flow, but that's still higher risk. And so you can see that the better the class, if it's a Class A or Class B property, the lower the cap rate is. So it's not necessarily good or bad, it's just lower risk, potentially lower return, but more stable return versus higher risk, higher return equation. Similarly, on interest rate, a lot of people would argue that there's not a lot of correlation between interest rates, but with the dramatic swings that we saw in the last few years, given the stimulus, the inflation, and increasing the interest rates, trying to slow down the activity, it had a very significant impact on the cap rates. Just as borrowing becomes more costly, the investor's appetite to investing will decrease, which will continue to expand the cap rate, just to kind of stay competitive. So unless the owner, the seller, are in a bad situation, or they want to free their cash, or they finish their business plan, we'll see, and we have seen this in 2023 and late 2022, a significant reduction of transactions in the market because of high interest rate, and the cap rate isn't expanding directly after the interest rate hike. But typically, the cap rate would expand within 12 to 24 months after interests continue to push. So I wanted to show some real examples of the view. We like Texas. We work in Texas. I'm in Houston, and we operate in Houston for most of our investment. So I'm going to focus on Houston, but you can take this and apply it to other markets. Cap rates in Houston, this is a summary table that shows the different classes and the different asset types as of this morning, actually. So you see, and this, because Texas is a non-disclosure state, it's not easy to always get these accurately, but for the most part, these will give us a good ballpark around where the assets are today. You can continue to see that multifamily is one of the most favorite asset classes when it comes to cap rate, and hence the lower numbers across the different classes, followed by self-storage and industrial. There's more demand on light industrial recently than big boxes, but still very attractive to the investors and continue to drive investment in those sectors. A little slowing down on the retail. It depends on the suburbs, tend to be a lot stronger than the downtown CBD area. Office continue to struggle. We have record high vacancy in the office across the board and in Houston as well. And then hotels, they're sort of still recovering, but not as attractive as they used to be in the last decade or so. So at a high level, it shows you that different cap rates, different appetite for these asset classes and for the property conditions as well. If we dig deeper into each sector on its own, this is a busy chart, so I apologize for that, but I wanted to just show you that there's several factors that drives cap rate and drives the value of the property. And so on the multifamily side in Houston again, you'll see that over the COVID era, we had a significant drop early 2020, and then the stimulus and all the lower interest free money frenzy that led to high volume transactions and almost nothing in 2023 for the most part. And what that did, combined with a relatively flat occupancy rate, it really started to push the cap rate up. So meaning that the average price started reduction. We started seeing, I would say, an average of 15 to 20% across the board in Houston, given the post-COVID prices. And we're almost balancing out to where the prices used to be in 2019. So we're almost like back to pre-COVID values and pre-COVID cap rates. And you can see here that the cap rate from last year, on average across all classes, grew from 5.82 to 6.26. When it comes to retail, similar phenomena continue to drop in cap rate and flatten it out and started to expand slightly. What's different about retail, there's still a significant amount of demand that was driven by the e-commerce and transformation of the need for last mile shipment and the different needs from retailers post-COVID. Vacancy continues to be very strong, very low vacancy rates in the retail space in Houston. But you can see here, because of interest, nobody's transacting. Very small volume of sales happened last year. We expect that to change next year. I mean, this year, 2024, but 2023 was record low. Absorption continues to be strong, and delivery is relatively mild. The market still can accept a lot more development in the retail space, especially in the suburbs growth areas in Houston. So overall cap rate is staying relatively flat. It's decreasing a bit to 6.8. Industrial, on the other side, has seen a significant demand over the past few years. Sales volume started to drop for existing buildings, but the trick in industrial is there was a lot of new deliveries in Houston. So you can see consistent growth on the new development of industrial, the big boxes and the flex space and the smaller light industrial, coupled with relatively strong demand that continues to be above average. And that is driving the occupancy and the vacancy basically to start to rise because there's a lot more deliveries, but demand's still relatively strong. The cap rate is impacted by finance, and you can see that cap rate has expanded as well in the industrial space. A little bit of dip on the prices, but it started to recover and the price per square footage is relatively flat for the industrial. I'm not going to cover the office because it's not doing well. I don't know who's going to be picking those up, but the banks are also struggling with the office and hotels. We don't participate in hotels, but you would see similar metrics for those segments. All right, moving on to common cap rate misconceptions. And some of these are not necessarily wrong or true statements, but I wanted to cover the nuances when we have conversations in the industry about these. The first one is relatively easy to deal with, is higher cap rates are better. That's it's against logic or anti-logic, but higher cap rates means higher cash flow for that property, but that always comes with higher risk. Better or worse, higher risk, higher return versus lower risk, lower return. So typically investors, the better the property, the better the market, the lower the cap rate. Doesn't necessarily mean it's a better investment. It just depends on the operator's experience and what they're specialized in. Are they specialized in value add operations where they buy properties and improve them like we do and take them to the next level and improve the financial performance? Or are they looking for turnkey, park the money, long hold game plan? And there's no right or wrong in this equation. The second one is cap rate and interest rate are not correlated. I'll share a chart in the next slide, but they are coupled. There is a lag between the two, but like I mentioned earlier, the interest rate, as it continues to increase, it will make the investments less and the volume of the investment decrease, and none of the properties will underwrite for acquisition. So if the seller is operating well and cash flowing well, they don't need to sell. They're not really a seller. They're just going to hold those until the market is in a better place. So what we're going to see this year, and you'll see in the next slide, there's a chart that shows where we believe the market is going to go and the correction, and all those potentially default loans and maturing loans are going to balloon. And so that will force a correction in the market, decreasing the value of the properties and expanding the cap rates. So they are correlated, but there's a bit of lag between the two. The third one is operator can impact cap rate easily. A lot of operators will tell you that, yeah, they have the ability to change the cap rate. And that's, I wouldn't say it's a myth, especially not in this environment where everything is more expensive from an OpEx point of view. Labor is more expensive, insurance is more expensive, taxes are more expensive. So there are certain cases where the property might be in a lower class than the area, and the area can handle a true value add and taking the property to the next level with the proper CapEx and OpEx management. But it's not an easy task. Yeah, there's certain ways you can skin the cat, and there's not a lot of juice left in most of these properties. So it may have been easier when cap rate continues to decrease and the market was helping a lot of the operators, but that's not the case. And there's a lot of headwinds for operators to try to improve the position of the property. And finally, the revenue and OpEx doesn't impact cap rate. From a theoretical point of view, that's true. That cap rate is, like I said, more market, capital market, investors market driven. But what we've seen recently in multiple states, but mainly the coastal counties and the coastal states on the Gulf of Mexico, given the hurricanes in Florida and Louisiana and Texas, a lot of insurance costs in some areas in Houston has doubled already, as high as Oklahoma City and Dallas, even away from the coast. So insurance, among other expenses, has skyrocketed. Property taxes also has increased significantly with the increases in value. the recent increase in value in the last couple of years, inflation and labor. Utility has doubled in certain areas when it comes to electricity and general utility costs. So what that does is it might impact cap rate in certain markets or submarkets. For example, in Houston, we now recently started to avoid all the coastal counties in our search for new acquisitions. And so we, you know, submarket wise within Houston, you might see that there'll still be strong markets in the north, northwest, west side of Houston, but relatively more impacted cap rate in the coastal county. You may not see this in Tampa, but you may see it in other cities in Florida, for example. So although it's not a direct correlation, but you'll see that investors are started to avoid certain areas in the market just because of operating expenses. The same can be said about the rent growth. As COVID pushed the rent significantly higher in the last couple of years, we started to see that rent growth started to slow down and flatten in most areas, or go back to normal, I would say. And in some areas, they're actually declining a bit. So that also changes the appetite for certain markets and submarket, and hence the impact on the cap rate. On the left side, this was an older chart, but I wanted to show you the relationship between the Treasury, which drives most of the interest rates for commercial real estate property loans, and the cap rate across all sectors. So you can see here in 2007, there's that continued decline in interest, and you can see that this was the delay after that significant drop, and then it followed it. The delay typically is 12 to 24 months. I would say in 2024, the delay was almost like 45 days. When they started raising the interest rates, the market just shut down within a couple months. Starting in summer 22 towards almost Q3, Q4 last year. But we started to see a pickup in volume, and a lot of distressed properties have started to show up as well. In fact, in Houston alone, I think there's 3 or 4 properties already that went to the auction. I know a lot of the lenders are trying to modify the loans and work with the operators, because there's a lot of loans that are going to be maturing, and lenders don't want to end up with these properties. But in certain scenarios, there's just no way out, and the lenders have to take them to the auction. I will finish with a brief look at 2024. We will be doing our next month webinar. We're going to dig deeper into the 2024 outlook, so stay tuned for that. But at a high level, like I mentioned, this is a chart that shows the loan maturing, starting peaking in 2023, and actually it's going to be the top in 2024. The vast majority are multifamily and office that are going to be in bad shape, and then followed by retail and hotel. Industrial should do well, but we started seeing a lot of office and multifamily in a distressed situation. So if the sellers are not, or if the operators are not able to work with the lender, there's going to be a lot of opportunity for new investors to inject capital and work on those properties and acquire these properties. At a high level, latest reports in Q3, late Q3, early and Q4 is inflation is finally getting under control. And against some of the recent conversation, maybe back in the summer, where they said, you know, job market is strong and it's not slowing down at all. The last couple of news articles talks about the major layoffs in the big 4 firms. Salaries are slowing down. Tech continue to lay off, even in the AI space, believe it or not. So there's a lot of strong markets. Manufacturing still growing, and then the medical obviously is still growing, but there's significant slowing down indications from the market, both on the job side and the salary side, which is in a way good news that the Fed started to indicate that they're going to ease in 2024, up to 75 basis point, probably three drops, potentially four between now and the end of the year. And the bottom left chart here shows the probabilities from the Fed Watch, from the CME group, that shows the probability of dropping and easing starting in early Q2 into the summer and late into the year. So we may not see something in Q1, is what most analysts think, but starting in Q2, Q3, and Q4, we'll start seeing the interest rate cool down a little bit. And if they see that, given that we're in an election year, and normally elections year are wild, and most of the time they want people to be happy in election years. So we'll see if that has an impact on the Fed movement. But in general, I think they're now worried that they might damage the economy and not have that soft landing they're dreaming of. So we might see some acceleration if Q1 job reports are not that strong. We do have record vacancy in offices, and that's just going to create a lot of problems for the lenders. Multifamily follows that, but offices, I think, are the #1 problems when it comes to potential defaulting with the banks. We talked about the loans peaking. The loan maturing is going to be all high in this year, and that will provide a lot of opportunity for new investors to come in and correct the situations. This wave of distressed properties, we believe it's going to further correct the market. And in multifamily alone, we expect discounts to be 30–35% of where they used to be at the peak of when everybody was sugar high. But I think now we're kind of facing that reality. Luckily for us as InvestStream, we didn't participate in that era. So we started picking the properties at the right times, and we didn't have any properties in that space. But there's a lot of properties that are, operators are experienced and working hard, but the market shifted on them really heavily, and they're trying to make it work with the banks and with managing those properties tightly. One indication that is really interesting is the private equity dry powder cash is at all high. It's a record. That's 2.59 trillion globally, and they're just waiting. They're just waiting. There are certain areas that they started to deploy capital in, like data centers recently, given the expansion of AI needs from a computing point of view. But that just tells you that everybody's waiting for the correction to happen, and they're going to scoop a lot of properties. So we're going to try to do our part to participate in that market. So I would say most forecast shows that although there are the distressed properties showing up, although that the Fed is decreasing the interest or potentially decreasing the interest, most forecasts continues to show that cap rate will actually expand into most of the year and into 2025 before it comes back as the market corrects. So we're going into acquisitions assuming that cap rates are going to expand before they shrink, and we're looking at properties that can cash flow on their own, even if we don't do any value add operations, and obviously adjusted for the increased expenses. Briefly, I think I touched on most of these. Our approach at InvestStream: location, location, location. We love above average, national average job growth, population growth, rent growth. We love Texas. We're staying in Texas. We want to expand in Texas. So Texas checks the boxes in Houston, Dallas, certain markets in San Antonio, and even the secondary markets. We also like Oklahoma City as an extension of that growth. Property type-wise, we're specialized in multifamily asset management, so we would like to continue to focus on that from an acquisition and management point of view. But we started to grow our development into light industrial and retail. We have started a project last year, and we're working on a few other projects this year. We like to be in a position where we force appreciation and control our destiny and not rely on the market. And so true real value add to our investors. So we're not hedging against the market, or we're not working with the market, we're hedging against the market. Property condition. We don't like crazy projects, at least not this year. This might change as the markets start to settle down, but we like to stay in the moderate value add projects. You know, good old basics, get good bases on the purchase, tightly manage the operation, and we're very selective in our acquisition criteria this year. We're going to be very, very selective. So if the property doesn't add up, we're not even looking at it. If there's no story behind it, we're not even looking at it. From an interest rate point of view, interest rate will continue to be challenging, although it's going to ease a little bit. So we have and we are continuing to deploy a few creative financing strategies. In 2023, we had 2 projects where we did seller financing, and then we had a position where we had the seller participate as an investor as they cycled the project with us. So we're going to continue to find ways to, I would say, save the properties and create a win-win situations with operators who have to let go of their properties. And you know, creating that win-win situation saves the industry and continue to have these properties operating well. A little bit about us. I was in oil and gas for 15 years before starting investing about 3 years ago with my business partners, Baha and Yusuf, who come from also an interesting background in medicine and pharmacy and serial entrepreneurs. You know, starting at COVID and, you know, trying to start a new business in the spaces where we had all experience in. I had 2 startups in my background and led 3 business acquisitions in oil and gas. And my last tenure was championing a multi-billion-dollar business transformation at Baker Hughes, and before that at General Electric. And so we're treating asset management as a big business. We're not looking at this as a side job. I'm full-time into this, and we are growing our team into the space of business acquisition. And recently, we've recruited my Uncle Wes from Oklahoma City. He's also was in IHOP business and Jack in the Box businesses, and grown his real estate development experience, developing his own multifamily, retail, and restaurants. So we're adding that skill set and expertise on the development side, and we're excited about what we're going to do this year. And then you can see here the rest of the team. I'll just go quickly. As the market is adjusting, we're building our systems and processes and growing the team to make sure we can handle the inflow of deals hopefully this year. This few samples of assets that we have under management as of today, all in Houston, as you can see, between multifamily and light industrial. These are past development projects, single tenant retail, and the IHOP and the Jack in the Box stores, most in Oklahoma City. And we also participate in a lot of deals as passive investors ourselves. I know we talk a lot about, you know, being active and going and acquiring these properties and working day in and day out on them, but we are also passive investors in others deal where we believe in certain markets that we're not heavily present in, but we love the Atlanta market, we've Dallas-Fort Worth, we've invested in Phoenix as well with other partners. So where we see an opportunity for growth, we like to participate as passive investors as well. With that, I'll open it for Q&A. We'll leave in the QR code on the screen. If you like this content and future content, you can join this series, and we'll be happy to go through future educational sessions with you.
Hey Al, hey guys. Hey, this is Jay. I'm just curious. We know that 2024 is going to be, one of these years where a lot of things are going to happen. But you mentioned, win-win situations. And I think with the struggle of operations, and on top of, as I mentioned, these bridge loans coming in, I do see a lot of opportunities, unconventional opportunities. How do you guys figure you would be able to wiggle some room in making some things happen in that space?
Every scenario is different. There's multitudes of like how deep in the hole the current operator is, to be honest. If there's an opportunity to take over and save the investors money, that's normally the first step we like to see. Maybe there's, the current management of the property may lose their shares in the property, but we save the investors money and we don't need to go to the bank. That's one way where you know that basically they hand over the property and we save everybody's investments and we inject extra additional capital in the property. Other ways is literally just injecting new capital into the property, and a lot of the times these deals are struggling because they just ran out of funds and they cannot inject more capital into the property to float them until 2025. Everybody wants to float their property until 2025. So that's another opportunity. A third opportunity may be um, where we can put in an offer to the seller, but not pay them directly,
Right.
but in exchange of giving them shares in the new investment. So that's another way from save the deal, delay their reward without risking the property, and then we don't have to inject the capital up front, maybe not to the purchase price, but to actually capex and improving the position um, of the property. So I guess it depends. It depends where how deep in the hole is the property and if there's ways to salvage the property. But in a way, we try to make sure that we communicate with the current operator and collaborate before it's too late.
I totally appreciate that view. And I bring that up because I was speaking with my brokerage, and we were kind of looking at it in the same metric that you were, maybe even introducing, a master lease agreement. Like you said, we're trying to float these properties to 2025, and maybe come in. Get the property to operate more efficiently, and save that initial investors credibility with the lender, right? We're saving that property. They're getting all the stripes for making mortgage, but like you said, having that price set for a later purchase date. But I was just bringing that up because I think it's something that a lot of folks aren't digging into, those creative ways to get into these properties.
Yeah, and a lot of the times it's a phone call from a lender that says, "Hey, do you want to talk to these operators? We think they're like 3 to 6 months away from, the phone call." And sometimes the operators obviously high emotions and they don't want to talk about it and they're still hopeful they can save things. And sometimes the operators are mature and they understand the situation. And there's a lot of strong operators who've done well over the years. It just got caught in the market.
Thanks, Al. Appreciate it. Thanks for your insight.
Absolutely. I see a new question from Hani. How may one participate? Yes, so our system, Hani, is that we do syndication for our deals. It's an SEC approved process where we create an SEC LLC, SEC compliant LLC, and we divide the property into shares so people can invest buying shares in the property. It's one LLC per property per project, and that's how we pull our investors' money into the deal.
I have a quick question. So thanks for this informative presentation, and very helpful to understand the metrics that are used to making wise investment decisions. So could you clarify for us, like when we are talking about operating expenses, are you looking at 1 year, the past year of that property, or you are averaging over multi-years? Because most of the properties would have large expenses, like when you're trying to do major renovation. Let's say you need to replace a roof, you need to replace windows, but those are not every year. So how do you time this? How do you calculate this operating expense overall?
Yeah, so if I'm not an accountant, but I know a little bit about CapEx versus OpEx. So CapEx is money you spend that has a lifetime, that has that you can depreciate over years. So if you're doing major renovations, not your typical maybe clean the unit and paint the unit and replace the carpet, those don't count. But if you're doing major renovations, those are CapEx. CapEx is typically spread over multiple years, and it's not considered operational expenses.
Okay.
Operational expenses are more the within the year type of expenses. So property insurance, property tax, labor, supplies for carpet, paint, turns. You know, if you turn the units, if you're just cleaning after, you know, the tenant turns, doing basic maintenance, landscaping, all of that is operational expenses. So when we say operational expenses, it's within a year. Anything that goes beyond a year, that's normally capitalized expenses that you can spread over multiple years. But this is more of a CPA conversation as how you split the expenses.
Understood. So basically, when we take a cap rate in itself, could not be used as a single metric to say this property will be profitable in itself. We need to add probably other metrics.
That's true. That's true. So if, in simple terms, when we look at a property, we look at the purchase cap, but we add what we call an all-in cap. So all-in cap is all the money we're going to inject to renovate, CapEx, reserve, for interest, for operational account. So you'll see a CapEx as you buy it, and then there's a CapEx that includes all the additional capital that you inject in.
All right. Thanks for clarifying.
Yeah, but from a definition point of view, it's operation. NOI is operations over the purchase price.
Okay.
Thank you again for joining today. Appreciate your questions and insight. Looking forward to seeing you in a future webinars. Have a good day.